To the untrained eye, the stock market appears to be an engine of chaos. It is a bewildering storm of rising and falling prices, a spectacle of flashing numbers and volatile swings that seem to be driven by an endless stream of news, rumor, and unpredictable human emotion. The average man caught within this storm feels powerless. He buys on hope and sells on fear, perpetually reacting to events rather than anticipating them. But this perception of chaos is a grand illusion. The market is not random. It is a highly logical and deeply psychological mechanism that operates according to a clear and repeatable structure. It was Richard Wyckoff who, over a century ago, first dedicated himself to mapping this structure. He proved that the market has a life cycle, a predictable sequence of phases that governs its every move, from the smallest intraday wiggle to the grandest multi-year bull and bear markets. This video is Wyckoff's ultimate beginner's guide to that structure. It is a journey into the foundational principles of his method, designed to teach you how to read the market's map. This map consists of 4 primary phases. First, a period of quiet preparation known as accumulation. Second, a sustained advance known as markup. Third, a topping process known as distribution. And finally, a sustained decline known as markdown. To understand these 4 phases is to understand the very logic of the market itself. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The entire Wyckoff cycle begins in the ashes of a prior bear market. After a long and often punishing decline, when public sentiment is at its most pessimistic and the news is universally bad, the first and most critical phase of a new bull market begins. This is the phase of accumulation. It is the foundation upon which the entire subsequent advance will be built. The psychology of this phase is crucial to understand. Accumulation is the process by which the market's largest and most informed operators, the entity Wyckoff termed the Composite Man, quietly absorb the available floating supply of a stock from the public, or weak hands. This is a deliberate, methodical campaign conducted with immense patience and skill. The Composite Man, with his superior access to information and his deep understanding of value, recognizes that the stock, after its severe decline, is now undervalued. He sees a future that is invisible to the crowd, a future where business conditions will improve and the stock's earnings will recover. He intends to build a large position in anticipation of this future, but he must do so without alerting the public and driving the price up against himself. Therefore, he requires an environment of gloom. He needs the average investor to be so discouraged, so fearful of further losses, that he is willing to sell his shares at bargain basement prices. The entire process of accumulation is a massive transfer of ownership. It is the transfer of stock from weak, emotional, and uninformed hands, who are selling at a loss because they can no longer bear the pain, into the strong, patient, and highly informed hands of the Composite Man, who is buying because he has a well-reasoned plan. The Wyckoff analyst's first task is to learn how to identify the subtle but definitive signs of this hidden buying. The campaign of accumulation unfolds within a sideways price channel known as a trading range. This range has a clear upper boundary, which is resistance, and a lower boundary, which is support. It is the action of the stock within this range that provides the clues. Wyckoff broke down this phase into a series of logical, sequential events, each one providing a piece of evidence that demand is quietly overpowering supply. The very first event in an accumulation schematic is the one that stops the prior downtrend. After a stock has been falling for a considerable time, the decline will often accelerate as the last of the public holders capitulate in a wave of panic. This culminates in a dramatic event known as the selling climax SC. On a price chart, this appears as a day or a series of days with an exceptionally wide price spread, where the stock plunges to a new low on climactic or extremely high volume. This is the moment of maximum pessimism. It is the point where the weak hands, in their desperation to escape, dump their shares onto the market without any regard for price. This is precisely the opportunity the Composite Man has been waiting for. He steps in with immense buying power and absorbs this deluge of selling. The key characteristic of a successful selling climax is that the price, after hitting its extreme low, will often rally strongly to close well off the bottom. This shows that the buying power was so great that it was able to completely overwhelm the panicked selling and reverse the intraday trend. This is the first powerful piece of evidence that a major turning point is at hand. Often preceding the selling climax is a more subtle event known as preliminary support PS. This is a point where the first significant buying appears after a long decline, characterized by a noticeable increase in volume and a widening of the price spread. While this initial support is usually not strong enough to stop the decline completely, it is the first footprint of the Composite Man and serves as an alert to the astute analyst that the end of the downtrend may be approaching. Following the violent action of the selling climax, an almost reflexive rally occurs. Wyckoff termed this the automatic rally AR. This rally is caused by the sudden vacuum of selling pressure. With the public having exhausted its supply of stock in the climax, even a moderate amount of continued institutional buying, combined with short covering from bearish traders, can cause the price to rebound sharply. The high point of this automatic rally is extremely significant, as it establishes the upper boundary, or the resistance line, of the forthcoming trading range. The market has now defined its territory. The low of the selling climax establishes the support, and the high of the automatic rally establishes the resistance. The battle between supply and demand will now be fought within these confines. After the automatic rally has run its course, the stock will invariably drift back down to test the area of the recent selling climax low. This is the next critical event, the secondary test ST. This is a moment of truth for the market. If the intense selling that caused the climax is truly over, then this test of the low should occur on significantly diminished volume. The price will approach the prior low, but the volume will be a mere fraction of what it was during the climax. This is the second and vitally important sign of accumulation. A successful secondary test on low volume demonstrates conclusively that the intense selling pressure has been exhausted. There is little or no stock being pressed for sale at these low levels. The sellers are gone. If, on the other hand, the secondary test occurs on high volume and the price breaks decisively below the selling climax low, it indicates that the liquidation was not completed and that a resumption of the downtrend is the most likely outcome. Therefore, the successful secondary test on low volume is an indispensable confirmation. It validates the selling climax as a genuine turning point and proves that the initial powerful buying was the beginning of a deliberate campaign of accumulation. The stock is now safely contained within its trading range, and the Composite Man can proceed with the long process of absorbing the remaining floating supply. With the boundaries of the trading range established and the exhaustion of major selling pressure confirmed, the lengthy process of accumulation begins in earnest. The stock will now oscillate within this range for what can be weeks, months, or in some cases even years, as the Composite Man methodically absorbs shares. This long sideways movement is the cause that is being meticulously built for the future effect of a sustained advance. To the untrained observer, this period appears as a dull, lifeless market, devoid of opportunity. But for the Wyckoff analyst, it is the most crucial period of study, for it is here that the most subtle yet powerful signs of hidden buying are revealed. The primary analytical task during this phase is to continuously weigh the evidence of price and volume on the swings within the range. The key characteristic of a genuine accumulation is this: volume should tend to expand on the rallies from the support level up toward the resistance level, and it should noticeably contract on the reactions from the resistance back down toward the support level. The consistently shrinking volume on each successive decline within the range is of paramount importance. It indicates that fewer and fewer shares are being offered for sale on each dip. This is direct evidence that the floating supply is being absorbed. Sellers are becoming scarce. The Composite Man may test the supply repeatedly by allowing the stock to drift down toward the support line. If very little volume appears on these tests, he knows that his campaign is succeeding. Another powerful indication that often accompanies this volume signature is the appearance of higher supports or higher lows. After the initial low of the selling climax and the secondary test, each subsequent reaction within the range may stop at a slightly higher level than the one before it. This shows that buyers are becoming more eager and aggressive. They are no longer content to wait for the price to fall to the absolute bottom of the range. They are willing to pay slightly higher prices to acquire shares. This subtle but persistent lifting of the support points is a clear sign that demand is quietly but surely overpowering supply, long before any public breakout occurs. The Wyckoff analyst watches for this combination, diminishing volume on reactions and the formation of higher lows, as the most reliable evidence that the stock is passing from weak hands to strong, and that the foundation for a major uptrend is being soundly built. As the process of accumulation nears its completion, the Composite Man often employs a final, powerful maneuver to ensure the path is clear for the coming markup. This is the spring or shakeout. A spring is a sharp and usually brief price movement that penetrates the established support level of the trading range, only to quickly reverse and climb back into the range. This maneuver is a masterful piece of market manipulation designed to mislead the public. A break below a support line is almost universally seen as a bearish signal, prompting the last of the nervous long holders to sell their positions and encouraging new short sales. This allows the Composite Man to hunt for stop-loss orders and acquire the last of the available shares at the most advantageous prices. The key to identifying a spring is the price's rapid recovery. It does not linger below the old support line. It quickly reverses and climbs back into the trading range. This swift reversal is one of the most powerful and reliable buying signals in the Wyckoff methodology. It is a sign that the last of the sellers have been shaken out. The track is now clear of any significant overhead supply, and the stock is now coiled like a spring, ready for a powerful upward move. With the accumulation phase complete, the stock enters the second phase of the bull market cycle, the markup. The psychology of this phase is the direct opposite of accumulation. The Composite Man has finished his quiet buying campaign. The stock is now firmly in strong hands, and the available supply has become scarce. The path of least resistance is now definitively upward. His objective now is to engineer a sustained advance, attracting public participation along the way, which will allow him to eventually distribute his large line of stock at much higher prices. The first definitive sign that the markup phase is beginning is the jump across the creek, JAC. As we have established, the upper resistance line of the trading range is the creek. A jump across the creek is a decisive, powerful price movement that carries the stock clear out of and above this long-standing area of resistance. A genuine jump across the creek is not a timid or hesitant event. It must be characterized by a marked widening of the price spread, and most importantly, by a significant and substantial expansion of trading volume. This high volume is the irrefutable proof that powerful demand has entered the market, and it confirms that the breakout is genuine. Often after this initial breakout, there will be a small pullback or sideways consolidation, which Wyckoff called the backup to the edge of the creek, BU. This maneuver brings the price back toward the level of the old resistance line, which should now act as new support. The defining characteristic of a successful backup to the edge of the creek is a dramatic shrinkage of volume. This low volume is the final, conclusive proof that the sellers are gone. This last point of support offers a final, excellent low-risk opportunity to initiate or add to a long position. Once the breakout is confirmed, the markup phase unfolds as a sustained uptrend. A healthy uptrend has a very specific structure. It is a persistent series of higher highs and higher lows. Each upward swing pushes the price to a new high, and each subsequent reaction, or correction, stops at a higher price level than the one that preceded it. This stair-step progression is the visual evidence that demand is in continuous control. The volume signature during this phase is critical. Volume should be strong and tend to expand on the advances and should noticeably contract on the reactions. This shows that there is enthusiasm on the buying side, while the selling is light and represents simple profit-taking rather than concerted distribution. Within this major uptrend, the stock will often pause in periods of consolidation. Wyckoff referred to these formations as reaccumulation zones, or, more colloquially, as stepping stones. These are smaller-scale trading ranges that form within an established uptrend, where the stock rests and digests its previous gains before continuing its advance. These stepping stones are highly bullish formations, and they offer excellent opportunities for the trader who is already in a position to add to his line, a practice known as pyramiding. Each successful stepping stone serves as a new, higher level of support and acts as a launch pad for the next phase of the advance. The entire markup phase is a logical, orderly process. It is the public manifestation of the power that was quietly built during the long, hidden phase of accumulation. Just as every bull market carries within it the seeds of its own destruction, every sustained uptrend must eventually come to an end. The markup phase, with its exciting advances and public enthusiasm, cannot last forever. Sooner or later, the Composite Man who patiently accumulated his shares at the bottom will conclude that the advance has run its course. He may see that business conditions are peaking, that the stock has reached a price level that is no longer justified by its future earning power, or simply that the public's buying enthusiasm has reached a fever pitch, a perfect condition for him to begin selling. This brings us to the third phase of the market cycle, distribution. This phase is the mirror image of accumulation. It is a period where the dominant market forces shift from demand to supply, and the ownership of the stock is methodically transferred from the strong, informed hands of the Composite Man back into the weak, uninformed hands of the general public. The psychology of the distribution phase is the inverse of what we witnessed during accumulation. The overarching sentiment is one of extreme optimism. The news is universally positive, financial commentators are bullish, and stories of easy money abound. It is precisely this environment of euphoria that the Composite Man requires to unload his massive line of stock without causing the price to collapse. His objective now is to sell his shares at the highest possible average price. To do this, he must feed his supply into the market to meet the public's enthusiastic demand. This process, like accumulation, takes time and is conducted within a distribution trading range. This is a sideways price channel that forms after a significant advance. To the untrained eye, this trading range may appear to be a simple pause in the uptrend, a period of reaccumulation, or a stepping stone for another move higher. This is a common and often disastrous mistake made by the public. The Wyckoff analyst, however, knows that this is a critical juncture where he must be on high alert for the signs of a major market top. The events that unfold within a distribution trading range are the mirror images of those seen in accumulation. The first sign that a powerful uptrend may be terminating often appears as preliminary supply PSY. This is a point where, after a long advance, a sudden burst of volume appears, and the advance is halted. It shows that for the first time, significant selling pressure is beginning to meet the demand. This is often followed by a buying climax, BC, the distributional equivalent of a selling climax. Here, the stock experiences a sharp, accelerated advance on climactic volume as the last of the public buyers rush in, consumed by greed and the fear of missing out. The Composite Man meets this frenzied buying with a massive wave of selling, and the advance is stopped dead in its tracks. The price often closes well off its high for the day, demonstrating that the supply was great enough to absorb all the demand. Following the buying climax, an automatic reaction occurs. The sudden influx of heavy supply causes the price to drop, establishing the lower boundary or support of the new trading range. The high of the buying climax establishes the resistance. The stock will then rally back toward the high in a secondary test of the resistance. A key sign of a topping formation is when this secondary test occurs on diminished volume, and the price fails to reach the high of the buying climax. This shows that the buying power has been significantly weakened. Throughout the distribution trading range, the Wyckoff analyst watches for key signs of weakness. Volume will tend to expand on the declines within the range and shrink on the rallies. This is the opposite of the volume signature seen during accumulation, and it proves that supply is now the dominant force. Rallies will become labored, struggling to make upward progress even on high volume, a classic divergence of effort versus result. The price will begin to form a pattern of lower tops within the range, as sellers become more aggressive. Just as the Composite Man uses a spring to trap the bears at the bottom, he often employs its opposite, the upthrust after distribution, as a final deceptive maneuver at the top. An upthrust is a sharp price move above the resistance of the trading range that is designed to mislead the public one last time. It creates the illusion that the uptrend is resuming with renewed vigor. This entices breakout buyers and triggers the stop-loss orders of short sellers. The Composite Man uses this final burst of artificial buying to sell the last of his inventory. The key to identifying an upthrust is that the price fails to hold its gains and quickly falls back into the trading range, trapping the recent buyers. This confirmed failure is a definitive sign that the distribution is complete and is one of the most reliable signals to initiate a short position. Once the Composite Man has completed his distribution campaign, the stock is in an extremely weak technical position. The ownership has been transferred to weak hands, who bought on emotion at high prices. The informed interests who previously supported the stock are now sellers, or have no position at all. The path of least resistance is now definitively downward. This brings us to the fourth and final phase of the market cycle, the markdown. The markdown is the sustained downtrend that is the logical effect of the cause built during the distribution phase. The markdown phase begins with a decisive break of support. As the price falls out of the bottom of the distribution trading range, an event that can be called falling through the ice, the downtrend begins in earnest. The public holders who bought with the expectation of further profits now see the price moving against them. Their initial optimism turns to anxiety, then to fear. After the initial break, there is often a rally back to the underside of the old support line, which now acts as new resistance. Wyckoff called this the last point of supply, LPSY. This rally should occur on light volume, and its failure at the old support level is the final confirmation that supply is in control. It offers an excellent low-risk opportunity to initiate or add to a short position. A healthy downtrend, like an uptrend, has a clear structure. It is a persistent series of lower lows and lower highs. Each wave of selling drives the price to a new low, and each subsequent rally or correction stops at a lower level than the one that preceded it. The volume signature is the inverse of what is seen in a healthy uptrend. Volume will tend to expand on the decline, showing that the selling pressure is aggressive and the effort is producing a downward result. On the rallies, volume will noticeably contract, indicating a lack of genuine demand and proving that the rallies are feeble and represent only temporary short covering. Just as an uptrend contains stepping stones of reaccumulation, a downtrend often contains periods of consolidation known as redistribution ranges. These are pauses in the decline where the Composite Man may add to his short positions before engineering the next major wave down. After a long and punishing markdown phase, the stock will eventually reach a price level where it is once again perceived as undervalued by the Composite Man. Public sentiment will have turned from the euphoria of the top to the despair of the bottom. The news will be at its worst. And it is here, in this environment of maximum pessimism, that the entire cycle begins anew. The final climactic selling from a panicked public will be met by the quiet, deliberate buying of the Composite Man, forming a new selling climax and initiating a new phase of accumulation. This four-phased cycle, from accumulation to markup, to distribution, to markdown, and back to accumulation, is the grand structure of the market. It is a logical, repeating process that underlies all market movements, driven by the calculated campaigns of the market's most informed players and the predictable emotional reactions of the public. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, complete with explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. The true power of the Wyckoff method is not in guessing the direction, but in reading the logic of the Composite Man's actions. This ultimate beginner's guide to market structure is designed to provide you with the map of his campaigns. By understanding the 4 distinct phases of the market cycle and the key events that define them, you can begin to understand where you are in the market at all times. This knowledge is the foundation of intelligent speculation. It allows the trader and investor to move beyond the realm of hope and fear, and to operate instead on a plane of logic, reason, and foresight. It is the first and most important step in learning to act in harmony with the forces that truly move the market.